Hi, welcome back. In this session, I'd like to talk about a rite of passage that US companies in particular go through every 3 months, which is when they report their quarterly earnings. And this happens over a 3 to 4 week period, and company after company comes out with an earnings report, and that earnings report is assessed for long-term effects. In theory, each earnings report reports what happened to your company over a 3 month period. You say, how much can happen in a quarter? And you'd be sometimes surprised to find out. Because here's how the process works. Companies report their earnings and a bunch of other numbers. Markets look at those actual numbers and compare them to expectations. Those expectations were set before the announcement came out. And if the actuals are below expectations, markets punish companies, and they're above expectations, they reward them. Simple enough, right? But in this session, I'd like to take a deeper look at what happens on that report date and how that reaction can be different depending on whether you're an investor or a trader. So let me start off by drawing that distinction. It's a distinction I've used before between the two processes that I see in markets. The first, of course, is the value process, a process that I'm very fond of and very comfortable with. It's a process where you look at the value of a company based on its fundamentals, its cash flows, its growth, its risk. Now, I might use discounted cash flow valuation to do it, but you don't have to. You could use accounting numbers, you could use other processes for estimating intrinsic value. But what they share in common is they value a company based on the company's characteristics. Now, of course, there's the pricing process. What drives price? Very simply, it's Econ 101. It's demand and supply. What drives demand and supply? God only knows. It could be fundamentals. In theory, in an efficient market, that's all should matter. But in reality, markets are driven by mood, by momentum, by fads of the moment, and those things all play out in the price. Now, if you're a believer in efficient markets, of course, the price and the value will converge. Not only will they converge, but differences between the two will tend to be random. It's going to be difficult to find them. If you're any other type of investor, no matter what your investment philosophy, what you're playing with is some variant on that gap. So if you're an old-time value investor, here's what you do. You value a company. You believe the pricing process is crazy, but you believe also that eventually prices will converge in value, and that's when you collect your winnings. If you're a pure trader, you say, look, who cares about value? I buy at a low price, I sell at a higher price, I make money. The value doesn't matter. Two different sets of investors, two different games in play, and I'm going to argue that the way you look at an earnings report will depend very much on which of these two camps you put yourself into. So let's start off with the distinction in terms of information. When you look at information, you can very broadly categorize it as fundamental information as opposed to incremental information. Let me try to explain the difference, so it's a little fuzzy. Fundamental information is information or news that changes your views about a company's cash flows, its growth, and risk. So when fundamental information comes out, the value of a company changes. Incremental information is whatever affects the price at the margin. It could be fundamental. It could be things like earnings and revenues, which are fundamental information. It could be something else that's perhaps a proxy for fundamentals. The number of users that a social media company has, the number of subscribers that a cable company has. It could be something random for all you know, something completely uncorrelated with value. It's whatever markets fixate on at that point in time. Now, the line between fundamental and incremental information is not always easy to draw because even within the investor and trader camps, there can be distinctions. Let me give you an example. In its earnings report on January 26th of 2016, Apple reported the largest quarterly earnings that any corporation had earned in history. Now, in that same report, Apple also reported that it sold fewer iPhones than people expected it to sell. For whatever reason, markets looked past the earnings at the iPhone numbers. And essentially, the market price reflected that. There was a drop in value of about $30 billion in Apple's overall market capitalization on that announcement. Now, is that information about the iPhones fundamental information or incremental information? It depends on who you ask. Even within the investor community, here's where the difference can come in. If you're an investor who values Apple based on expected dividends, use an old-fashioned dividend discount model, an old-time value investor, your reaction to the iPhone report might be, who cares? Apple's not going to cut dividends. In fact, it has enough cash, $220 billion, to be able to pay dividends for as far as the eye can see. You might say your value is unaffected by that iPhone information. As opposed to who? Another investor who might value Apple based on its revenues and its operating income and its cash flows. And if you factor in that 65 to 70% of those numbers come from the iPhone, a drop in revenues in the iPhone, if it's a long-term transition to a declining market, could have huge effects on your value. So you could look at that same information and say that is fundamental information. Now, if you look at traders, you think they'd come to an agreement, but not necessarily. If you're a trader focused on earnings per share, that Apple report looked like good news. But if you're a trader focused on iPhone sales, it looked like bad news. What I'm trying to argue for is you should expect disagreements when you see earnings reports come out, because not everybody has the same agenda. Not everybody's looking at the same metric. And even if they're looking at the same metric, they might not look at it the same way. So here's my frame of reference for thinking about how traders and investors react differently to earnings reports. So here's the picture I have of how a trader would react to an earnings report. So let's start with the company. The company, before it even makes its earnings report, comes with a history of what? Of prior earnings reports. Whether it's beaten them in the past, whether it's matched them, whether it's fallen behind. A company can never run away from its history, so it starts with its history. You also have the financials as they existed before the earnings report. Think of that as the priors for the company. The earnings report comes out. And in the earnings report, you're going to get updated numbers for revenues, for earnings per share, perhaps the number of units the company sold. And you also increasingly at companies get what's called management guidance. That's where the company tells you what it expects to do in future quarters. Not that far into the future, but maybe 2 quarters out, 3 quarters out, maybe a year ahead, what its revenues might be and what its earnings might be. Now that wasn't common 20 years ago, but increasingly companies have taken to providing guidance. So that's the actual report. That actual report gets measured up against expectations. Now, the way these expectations usually get framed in the news is as analyst expectations. And so if you read a news story about an earnings report, it'll say the earnings came out at $2.55, but the consensus estimate among analysts was $2.51. Be a little careful, because that is a consensus across lots of analysts. There are high numbers and low numbers. In fact, you could argue that you want to look at the entire distribution, because there might be information in how much analysts disagree as there is in the consensus number. But there's a bigger issue. What the earnings report gets measured up against is not the analyst forecast or the analyst expectation, but the market expectation. Now again, you might see what's the distinction? Analysts are the market? Not necessarily. We'll come back and talk about it, but it gets measured up against expectations. At that stage, you're going to find that your company's actuals are either above expectations or below on each of these different variables, and expectations get reset. Now, how much they get reset will depend on the company's history. Some companies are more credible. They have a history of delivering predicted numbers. Those companies are cut a little more slack, but expectations get reset for everybody, and more for some companies than others. And then there's what I call the magic mirror. This is where the reset expectations get translated to price. And the reason I call this a magic mirror, it's more like a carnival mirror. Unlike a regular mirror that reflects what's going on in expectations, the market mirror can sometimes distort what happens. Sometimes it can make it bigger, sometimes smaller, sometimes change shape. But whatever that magic is, what you get to observe at the other end is the new price for the company. So you can already see that the way this process plays out is going to vary across companies. It's going to vary across time. It's going to vary across different types of earnings reports. And the complications that you're going to run into are going to come on 3 levels. The first is, remember that companies report their actual numbers on earnings per share, net income, operating income, revenues, number of units sold, number of subscribers, etc. I think you're well on fair ground asking which of these is actually going to move the price. And my answer is I don't know. It depends on the company, it depends on the time, it depends on the investors. But the reality is most earnings reports are mixed bags. The Apple report, for instance, had good news on earnings and bad news on iPhone sales. And the market reaction actually can vary across companies as to which of these variables they latch on to. And it can vary across time for the same stock, and it can vary across investors. So there's confusion about what that pricing catalyst is. Second, whose expectations? As I said, analyst expectations are not necessarily market expectations. In fact, here's an interesting feature. Over the last 20 years, companies have become increasingly clever about beating analyst estimates. In fact, some companies consistently deliver 3, 4, 5 cents above analyst estimates, partly because they control some discretionary expenses to allow them to do it. Now, if you consistently beat analyst estimates by 5 cents every quarter, guess what the market starts to do? It adds 5 cents to whatever the analyst estimate is, and that becomes your new expectation. In fact, some of you might have heard the term whispered earnings, and when I first heard it, my reaction was, who's whispering this to whom? But it reflects a very real adjustment that markets make to analyst expectations, because the market expectations are what the numbers get judged against. And finally, this is the price reaction. And that price reaction can vary across companies and can vary across time, partly because of the company's history. Some companies, as I mentioned, are cut more slack because they've had a stable history and they're more credible. It also varies depending on what the investor composition for your company is. Remember, I said that you can be investors or traders. If your company is predominantly a pricing stock, in other words, most of the people who own your stock are traders, not investors, you should expect to see a much more volatile reaction, because essentially that's what traders do. They react more to small incremental information events. If your investors are more investor-based rather than trader-based, then you're going to potentially see a much more measured reaction to surprises. And there's this overall effect that market mood does. Part of the reason I did this post in early 2016 is because we're in a market where the mood is abysmal. There is people in the way to think about this is it's like talking to a very depressed relative, and every time you give them a glass that's half full, they see that it's half empty. This market is very similar. It looks at news items and it seems to see the dark side more than the light side. So when it looks at a news story, it's almost like it's looking for reasons to make it bad news rather than good news. So that plays a role. You might say it's not fair. It's reality. That's how traders react to earnings reports. Now let's think about how an investor would react to earnings reports. Again, investors can come in different forms, from people who use dividend discount models to people who use discounted cash flow models to people who use accounting approaches to intrinsic value. But they all share a common feature. Embedded or behind every valuation is a story you're telling about a company. As many of you might know, I've been arguing that we should be explicit about these stories rather than implicit. But every good valuation has a story behind it. And the way I see an earnings report affecting me as an investor is I look to see how it changes my story. So when I look at an earnings report, I'm looking for richer information than the bottom line. It's not just the earnings per share. I'm looking at revenues and breakdown of units to see, does this change my view of the company? In what sense? Maybe it changes the view I had about the business of businesses, the companies, and changing my total market. Maybe it affects the way I think about its competitive advantages, which might affect the market share I give it and the margins that I give it. Maybe it affects the tax part of the story. Maybe it's telling me something about this company having to pay more or less in taxes. Maybe it's about how efficiently this company is growing. But everything you see in the earnings report affects some part of the story. And then after an earnings report, it's entirely possible that the story you're telling about a company can be very different than the story you were telling before the earnings report. Again, drawing some general conclusions, here's what I would argue that you should think about even as an investor. Don't fall into the trap of believing that every big price change is an overreaction. Put differently, there are some earnings reports that can cause big changes in value. So when you see the price drop, it might be reflecting a true drop in value. That kind of change is much more likely at young companies rather than mature companies. So when a young company reports an earnings report, you can see much bigger shifts in narrative based on a single earnings report than you will in a more established company. And finally, if you are looking at earnings reports and focusing just on the earnings per share, you're missing the big part of the story. So I would argue that we need to be a little more sophisticated about looking at the entire earnings report and asking, how does it change my story? So I hope I've given you some perspective on how investors and traders can look at the same earnings report. This is the first, hopefully, in a series of posts. And here's what I hope to do with my remaining posts in the series. The first is I want to make it real, because I've talked in abstractions now. I've not talked about companies. So I'm going to take a series of companies that I've been fascinated for a while. So the first pair, in the first post, I'm going to look at two of the largest companies in the world, racing for that top post, the largest market cap company, Alphabet, also known as Google, and Apple. Then I'm going to talk about two companies that are disrupting the entertainment business, Amazon and Netflix, and talk about how they are playing out in both the trading game and the value game. And then I'm going to shift to two companies that I've looked over since their IPOs. One is Facebook and the other is Twitter. And two companies that have diverged in their operating results. Facebook in a positive way and Twitter in a negative way. And talk about how management can affect how you react to an earnings report. or the quality of management, the trust in management. And finally, I'm going to focus on two companies that have been punished very badly in this earnings season, LinkedIn and GoPro, both of which have lost about half their value and half the price. And I'm going to ask the question: is this a value effect that we're seeing in play, or just a price effect? And it's going to make a difference in whether you actually end up investing in these two companies. After I look at the companies in those four posts, I want to turn to the two big players in this game. The first is the investors and traders and how they play earnings reports. And I'm going to set up a template for how, if you're an investor, you can approach and make money, perhaps profit from earnings reports, and how, if you're a trader, your strategy can be very different, and how each side can be a foil for the other. And the second is, I want to talk from the company perspective as to whether they want to be managing this process. Many of them want to do, and what the payback from, or the payoff from that is, or whether the blowback from that is, and ask, does it make sense for companies to try to manage the earnings process as much as some companies try to do? And finally, I want to turn to rule makers, because every time you have an earnings season like this one, talk begins to talk about how crazy markets are, where irrational investors are, how short-term markets are, and how we need to make this process more long-term. You might have read recently about Lawrence Fink, head of BlackRock, Jamie Dimon, the CEO of J.P. Morgan Chase, and Warren Buffett, and you know who, you know him well enough, coming together and coming up with a proposal to allow companies to focus on the long term. Implicit there is the message that markets are short term and that there is a better market that they would like to see. I want to talk about whether that is true, whether in fact we can take all these imperfections that we know markets have out of the game and leave the markets doing what they're supposed to do. And is there a way that you can use rules, regulations, and taxes to get to your perfect market? So those are hopefully the things I would, that I will get to in my remaining post. But that's about it for this particular one. Thank you very much for listening.